The Federal Reserve lowered interest rates by a quarter percentage point in an effort to support a weakening job market. However, the divided vote came in part because officials are weighing competing concerns. For example, inflation is still well above the Fed's target, which would ordinarily call for keeping rates elevated.
Here to wade through all of this with us and to break down what it means for your wallet is Michael Sury with the McCombs School of Business at UT Austin. Thanks so much for joining us.
Thanks for having me.
Okay, as Will mentioned, this vote is the first time in several years that three officials dissented. One was pushing for a larger cut, others wanted to hold off and to wait. So what does that division signal to experts like yourself about the conditions in our economy right now?
Well, it is unusual. This kind of disagreement isn't something that we normally see. We usually see Fed announcements come with an almost unanimous pronouncement, and it's delivered by Jay Powell, who's the chair of the Federal Reserve. But as you say, in this particular announcement, we saw that three of the policy members dissented. So two of them, Austin Goolsbee and Jeffrey Schmidt, wanted no change, while Stephen Mirren, who Trump favors, wanted a 50 basis point cut. So I think it's understandable given the current uncertainty that we have in both the political and economic environments, but it's going to be something to watch, especially as we have a change in leadership coming to the Federal Reserve starting next year.
We want to ask you more about the future in just a moment here, but I think the pressing question that people at home want to know is, what does this cut actually mean for my credit card, home, or my car loan?
Yeah. I'd say for rates that are tied to the Fed funds rate, which is the rate that the Federal Reserve has some influence over, and other short-term rates, it means that borrowing costs should be somewhat lower. This would include credit cards and home equity lines of credit. In fact, if you look at HELOC rates, they're down from over 8.5% over a year ago to about 7.8% today. Now, for mortgages, the story might be a little different. These tend to be tied to the longer-term 10-year U.S. Treasury rate, and that has not come down as fast as shorter-term rates. I'd expect that mortgage rates will probably trend slightly lower over the next year, but if inflation fears persist or more political Fed emerges, which we expect to see, then we could see some upward pressure on mortgage rates. On the other hand, if jobs continue to be weak or a recession looms on the horizon, then we could see a dip in the rates.
Okay, so the timing of all of this is very interesting too. The cut comes as the president begins touring the country, addressing higher prices, affordability concerns, and he even told Pennsylvania voters this week that he is, quote, crushing inflation. But Michael, how do you think that this move by the Fed will impact inflation?
President has indeed been on a tour promoting his policies and touting affordability. I think even given the cut in rates, he has a bit of an uphill battle because while inflation rates have dropped somewhat, they're still positive and prices are increasing in many categories. In fact, it's caused him to walk back many of the initial tariffs that he put on earlier this year in April, especially in certain food categories. So I think it still remains to be seen what will happen on the affordability front. I think the Fed having lowered interest rates might help. But there's still a lot of inflationary pressure out there.
We've talked about this a bit, but talk about the impact that this cut will have on the labor market, the job market, and the unemployment rate, where that stands right now.
Yeah, the Fed actually has a dual mandate, as Will mentioned earlier. It's to promote full employment and also have price stability, which means that they've got to control inflation. The inflation target is normally around 2%, and we're higher than that right now. And so you might argue that tariffs and immigration policy could add to these inflationary pressures. But on the flip side, you have unemployment rate at 4.4%, which, while that's not terrible, it has been creeping higher. And survey data is showing that this could become a problem as time goes on. We also have a Fed that loves to be data dependent, and that's the right move. But given the government shutdown that we had in October and November, it's been flying partially blind and relying on alternative data sources. So I think the Fed has been slightly biased towards reducing rates a little in order to provide some support to the jobs market. And the current rate is probably somewhere around policy neutral, meaning that the current level is not stimulating or restricting the economy in a certain way.
We've got one more question for you here before we let you go, Michael. The Fed also did signal that it would wait to cut rates again. So play a guessing game for us a little bit. What do you think is going to come next?
I'd expect that we would see a 25 basis point cut in 2026, and then it's going to remain data dependent. It's going to depend on where the unemployment and the jobs picture goes, as well as what we get from the more recent CPI data. Again, we didn't have a lot of visibility into the inflationary data because the last few months we weren't getting it due to the government shutdown. Now that the data is going to start coming out again, I think it's going to be watch and see. There are some market observers that expect to see as much as 50 basis points, and at least one or two that have mentioned that we'll see 75 basis points, but I think odds are we'll see 25 basis points in the early part of the year.
So much to watch, and thankfully we have Michael and the experts over at McCombs to help us wade through all of it. We really appreciate your time today.
Thank you so much. Happy holidays.